So we're still on accounting records. Today we want to talk about provision for bad debts. For provision for bad debts, a business tends to sell on credit to increase its sales and probably the profit. Or the business is selling on credit because its competitors do sell on credit. So those are the two reasons why a business would want to sell on credit, to increase its sales and as well profit, or because competitors are selling on credit. But as soon as this is done, as soon as a business sells on credit, it is important for the business under the accounting concept of prudence to make provision for bad debts. And when we talk about provision for bad debts, simply means that some of the customers might not be able to pay back. And if the customers do not pay back, the bad debt must be written off. And that is why we have to open an accounting record for provision for bad debts. So I'm going to start. Many businesses sell goods and services on credit to increase sales and as well profit, because competitors also sell on credit. We talked about that, and the prudence is taught. So the provision for bad debts may increase or decrease during the financial year. So for the provision for bad debts, it may increase or decrease during the financial year. If it increases, it becomes an expenditure for the business, it has to be debited. And if it decreases, it becomes an income for the business, it has to be credited. So, the creation of a new provision for bad debt. If a new provision for bad debt is created, it means we have to debit the profit and loss account and credit the provision for bad debts account. The same goes to an increase in the provision for bad debt. If there's an increase in provision for bad debt, we credit the provision for bad debt account, we debit the PL account. But on the other hand, when there's a decrease in the provision for bad debt, that becomes an income for the business. So we credit the P&L account, we debit provision for bad debt account. We credit the P&L account, we debit provision for bad debt account. So we have a question here. They said, we have a debtor of 80,000 and provision for bad debt of 3,000. Montoya, who owes 4,000, was declared bankrupt. As a result, the business increased provision for bad debt by 4% of outstanding debtors. We have to prepare the necessary accounts. So we're going to prepare a journal and a ledger. So in preparing the journal, we have the bad debts, which is 4,000, and we have the debtor, which is Montoya. So because we have a bad debt, it means there's a creation of a bad debt. So because there's a creation of a bad debt, we debit the bad debt account for 4,000 and we credit the debtor's account for 4,000 because it is written off. So the analysis of this account is being bad debt written off. The second transaction is we transferring the bad debt into the P&L account. In the course of transferring the bad debt into P&L account, we need to open the P&L account and the provision for bad debt account. So when we are transferring, the P&L account will have a debit balance of 4,000 and the bad debt account will have a credit balance of 4,000. Being transfer of bad debts to P&L. And the last one is preparing the P&L account. So they said we should divide that by 4% of outstanding debtors. So 4% of outstanding debtors, the outstanding debtor is for 80,000. So it means 80,000 minus 4,000, which is for Montoya, multiplied by 4 over 100. So that gives us 3,040. The previous provision for bad debt is 3,000, which means 3,040 minus 3,000, which is 40. So that means there's an increase in provision for bad debt. Because there's an increase in provision for bad debt, it simply means that we credit the provision for bad debt account and we debit P&L accounts. Thank you.